So we're going to look at our course outline and what we're expected to know. Basically, there are about 13 topics in this course. So the first topic, we'll look at the overview of corporate finance or managerial finance. So our expectations are to know the following. Number one, we should be able to provide an understanding on what the role of financial management is. Okay, the role of financial management. There are decision roles, financing roles, dividend roles. So we need to know those key important roles, and we should also should have an understanding on the financial environment, how the operation of the financial systems are, the financial and the money markets. In this course, we'll also develop a knowledge of understanding on the theoretical framework, the techniques that are involved in investing decisions. All right. Capital budgeting, what decisions are involved. We should also be able to understand the sources of finance and the ability to determine the financial requirements. If a company has no consistent cash inflows, what kind of debt, what kind of instrument would they need? Would it be equity or capital financing? You should also be able to have an understanding of the factors involved in working capital management. This should also take us to describing the relationships between risk and return and demonstrating the CAPM model. In this course, we also need to understand the relevance of the CAPM model to financial managers. We'll also look at the EMH, the efficient market hypothesis, and their relationship to the random walk model or theory. And we should also look at the international markets and how firms will fare in this globalized world. And finally, we should be able to understand and discuss the dividend policy. So chapter one, our concern is to cover the overview of corporate finance. So there are four key decisions that the financial manager should always be abreast with, what we call financing decisions, what we call dividend decisions, what we call investment decisions. So let's look at them in depth. So this unit will enable us to prepare a workplace for tomorrow. It broadens expectations of financial knowledge and skills. We should be able to understand the financial terminologies, the concepts, and develop cross-functional capabilities. So by the time we're done with this unit, we should be able to understand the goal of a firm, what corporate governance is, and also organization of financial management. So now we must look at what corporate or financial management is. So financial management or corporate finance is defined generally as the activities that are involved in making cash available for the business. So there are five key functions of corporate finance. Number one, financing. Number two, financial management. Number three, capital budgeting, risk management, and corporate governance. And these summarize the entire syllabus of what we're going to look at. So let's break this down. So financing basically looks at ways in which institutions will raise capital to support the company's operations and the investment programs. Financial management looks at how firms will manage the internal cash flows, how they're going to determine the mix of debt and equity financing to maximize what? To maximize the company's gain. We will also look at capital budgeting, where we're going to look at the appraisal methods that are used to determining the best viable projects to undertake. Risk management, where we're going to look at risk and return, understanding the types of risks that are there that a company is exposed to, both insurable and non-insurable, and how to minimize or diversify certain risks. In corporate governance, we're going to look at the ownership and corporate governance structures of companies, and ethics that are expected to benefit the shareholders. So there are three key decisions that are involved in financial management. We have what we call investment decisions, financing decisions, and dividend decisions. So what are investment decisions? So investment decisions are part of the most important decisions that involve financial managers being able to select the more viable investment projects. So it requires financial managers to be able to understand the capital budgeting techniques, which we look at as a single topic, NPV, IRR, how to calculate them. So depending on the nature of business, be it mining, retail, so these decisions that a firm will make will be dependent on the size of the firm, the assets that are required, and also assets, if any, that need to be reduced or eliminated. Financing decisions basically look at the type of financing that is needed. I will be asking questions by the end of this session. Please be attentive. And also the mix, whether to use equity or to use debt or to use a mixture of both. The dividend policy, this looks at the dividend payment ratio. So how funds will be acquired. So these are decisions when we're dealing with financing regarding how our investments will be financed. So the firms have three options regarding where these funds, finances will emanate. Will we get it from retained earnings? So when a business, as a company, even elsewhere, so they will have two decisions that will need to be made, either to borrow or to plow back the earnings that are made, which will be augmented into equity. So here comes now what we call the we have what is called a principal agent relationship that exists between the owners of the business and the business managers. So the managers are expected to operate in the best interest of the business. So sometimes because managers want to enrich themselves through bonuses, through job security and other incentives, instead of borrowing, they'd rather plow back the profits that are made. So now this is where these decisions have to be made. So they need to know. But that's just one source of finance that you need to know. And sources of finance that a business may have may either be internally or external. The internal sources may include the retained earnings or borrowing from the debt capital market or issuing out stocks. So when stocks are issued out, the business may finance itself, right, through ordinary shareholders or preferential shareholders. So the sale of shares is simply selling a part of the company in terms of share or holding or equity to raising finance. So we have different types of companies, can be private or public limited companies. Public are the ones that are allowed to float their shares on the stock market. This decision basically is on how much and which source to use for financing our business is determined by the type of investment, whether it's a long-term or it's a short-term investment. So the use also of this capital is also a key determinant. Is this for capital investment or is it for working capital requirements? So these are some of the questions that financial managers should ask, and they must have a balance between equity and debt for the benefit of the firm in general. They also need to make dividend decisions which involve determining the dividend policy for the firm. And now this dividend policy actually describes how the returns from the investment will be distributed among the shareholders in terms of dividends. A dividend is simply what? Um, um, the return on a share. So this policy actually will determine when and how much profits will be distributed as dividends, including the mode of payment. So as a finance manager, these are some of the roles that are performed. without overriding the roles of the managers of the business. So you have three key roles: investing. Okay, so what are the three roles that we've talked about that a financial manager should have? What are the three key roles that a manager should have? Number one,
The three key roles, the same as the three decisions that they have to make, which is the
yes.
dividend,
Uh-huh.
financing, and investment decision.
Exactly. Okay, so never forget those key decisions. Now, why or what is the goal of a firm? So different firms have different goals. Goals to maximize share price, others are there to maximize their worth, others are there to minimize costs or maximize the sales or maximize profits. So depending on the goals that a firm have, there are different goals or possible goals that may have, but these ones can best be categorized into these two mains. Either they want to maximize share price, for instance, a maximization of the shareholders' wealth, or to create value for these shares. So shareholder wealth maximization being one of the major goals of a firm. So number one, the strengths of shareholder wealth maximization is that it takes into account current and future profits, the timings, the duration, the risks, the dividend policy, and all other relevant factors. So this is one of the strengths of shareholder wealth maximization because it takes account of these. As a shareholder, you'd want to be preview to such information because you are investing, gambling, investing in this organization. All right. Then we also have some of the shortcomings of profit maximization objective. Number one is that it may increase the current profits whilst harming the firm, and it ignores the risk level that the firm may have in the future. It may not really consider all the risks that would be there. Modernization of corporation. So we want to examine same modern corporations on wealth maximization. So modern corporations, there's a separation between the owners and the managers of the business. So there's a special term that we use to differentiate these two. Who remembers that term? So shareholders are actually people who whose name has been entered in the register of being a shareholder, okay, who have applied to become shareholders upon incorporation. Management, management is simply an agent of these shareholders, so they act on behalf. So management is an agent, meaning they are given authority to act on behalf of the principal. So the owners of the business are called the principals, and the management are called the agents. So now these people may not have the technical know-how of how to handle the firm. So they're expected by being hired in the capacity of managers to act in the best interest of the business. But because of information asymmetry, what happens is that sometimes they may cheat their way in wanting to benefit themselves. Sometimes in the Western world, you will find that um, directors are actually held personally liable. In law, we call that vicarious liability, where a manager or director can be personally sued even if a business is known to be a separate legal entity. So this brings in what we call the agency problem. And this is a question that comes that you need to understand. Explain the agency problem. So agency problem is defined as a conflict of interest that arises between the principals, who are the shareholders, and the managers. It is actually created when managers will act in contrast with the expectations regarding the objective of wealth maximization. So agency problem is a situation where managers use these funds for non-value maximizing purposes. For instance, management may unnecessarily acquire expensive jets, cars, head offices, and incur travel costs, which may not benefit the entire organization as a whole. So it is necessary that shareholders will put in place some incentives to ensure that they monitor these costs, that managers should not what? Should not enrich themselves, but actually maximize the wealth of shareholders, because these are the people who actually invest in these businesses. So how do we deal with this urgency problem? Inevitably, this problem is there in most cases. The first way of incentivizing this problem is by having a structured managerial incentive scheme, which may include having to offer managers a share option whereby managers are given an opportunity to buy shares at a discounted price so that they should also act as shareholders in favor of their fellow shareholders. They are awarded this on basis of performance or using a certain criteria. So this means that management will be focused on the maximizing of their share or price. The other one is monitoring costs. So the shareholders could put in place a monitoring mechanism, for instance, auditors, to ensure that they check to ensure that the costs are in line with expectations. They also restructure the expenditure in the organization so that there is a possibility or an impossibility of undesirable expenses. Also putting injunctions of threats to firing when they are not acting in line with the expectations, or threat of a takeover where a hostile company may come to taking up their jobs if they don't act in the best interest. Are we following? Are we together so far? And there comes the concept of social corporate responsibility, CSR. So despite having the aim of or goal of maximizing wealth, it is expected that embedded in these corporations, they should have an assumption of taking care of the needs of the environment. Not only should share wealth maximization be a first priority, but also looking at the private needs of the surrounding. So we call that social corporate responsibility. It encompasses actions that a company may give or a private commercial organization may assume as an obligation to society, as a way of fulfilling the roles of your wider economic value. For instance, MTN in the way that they sponsor social games, the Mind in the way that they sponsor roads and education scholarships. So all these fall under the umbrella of social corporate responsibility. So it's an expectation. So it's a prime objective of management to set these financial objectives. So you see, in an event where a strike or a riot happens, it's so obvious sometimes that certain firms will stand in favor of companies that will protect the interest. So certain times you will see how that companies that operate in these lines are protected by the citizenry. So even if it's not the major or prime objective, it is important that these firms look at how they will take care of the needs of the surrounding environment. So management will need to set these non-financial objectives that will complement and support these financial objectives. So for instance, brand awareness, development successes, new product development, customer satisfaction levels, also upholding responsibility to customers by providing them after-sales services. All these will contribute to the society. It may not add to profitability, but in the long term may improve the response that people may have. So the arguments that have actually been put for and against corporate responsibility. For is that it creates a positive public relations for the organization. There's minimum vandalism, it attracts repeat sales, it improves staff recruitment and motivation, It also helps keep your organization within the law. Arguments against are that number one, the market is equal. You are not forced to induce or to redirect your monies to things that are not in line with your objectives. You've just opened a lodge and you want to start making a road on whose cost. And sometimes ethics of doing business are not of the wider society. No matter how much you do to society, they may never see. Sometimes governments should be responsible for the well-being of the society and don't bring it upon organizations to start repairing roads on their behalf. And also, an organization's minimum requirement should remain within the law, not more than what is required. So these are some of the arguments. Right. So with regards to corporate governance is simply an activity that involves the regulatory mechanisms and the roles and relationships between the company's management, its board, its shareholders, its stakeholders, and the goals which the corporation is governed by. So corporate governance, in fact, represents a system by which corporations are managed, controlled. It includes shareholders, the board of directors, senior management. And so when shareholder maximization remains appropriate in governing the firm, it will deal with relationships between management, shareholders, directors, and other stakeholders. So corporate governance actually includes policies, the procedures and processes that are put in place as a way of managing a company. Now, corporate governance includes checks and balances. These ones help to reduce what? To reduce the conflict between management and shareholders and stakeholders. Corporate governance brings in a separation of control and ownership. It is what has led to issues of accountability. How did this PAC come in? It was an issue of corporate governance, seeing how particular office bearers are acting in the best interest of the organization and vice versa. And management also should wield a substantial amount of power in light of these unlearned shareholders. So in other cases, minority shareholders may have little power, but because of corporate governance, they are protected. In UK, for instance, a report was documented on the code of the best practices to be followed by board of directors. In the USA, one of the largest institutions, it set out practices that are to be followed by the board of directors. So corporate governance stands into clear scandals that may occur. Examples, we looked at the Word.com, Tyco. These are just examples of instances where corporate governance interfered. So all in all, corporate governance is there to ensure that management and the board of directors will act in the best interest of the shareholders. Although increasingly, this also includes other stakeholders. So the board should be independent, and there should be an adequate system of internal controls that will be put in place. So here is a typical board that is set where we have a structure that has been put here, which has an enterprise of the governance structure. So the CEO can be the head of the organization who advise or can be advised by other senior executives. The role would be to fire and hire and set compensation plans. Okay, so there are three forms of businesses that we must learn of. Number one, there's a sole proprietor, which is a one-man business. Of course, can employ one or two employers, enjoys all the profits, and decisions are made solely by him. Unfortunately, the business dies upon his death and has limited pool of resources. Partnership is an upgrade of sole proprietorship, which now can have general and limited partners. Limited partners are limited to how much they invest, whereas general partners have all unlimited liability, and their activities are consequential to all members. So one bad decision can affect the entire partnership, such that upon having a problem or the members are affected. And so partnerships graduate into corporations or companies which can be divided into two, private and public limited. These have unlimited liability and a separate ownership from the business. They are governed by articles of association, which are the internal laws, the memorandum of understanding. Private limited cannot sell its shares on the stock market. They only are limited to few family members and internally advertised, whereas the public can trade on the stock market where anyone can buy, even a competitor. Advantage is that they have larger pool of source of finance that can emanate from bank loans, the sale of shares, retained earnings, many advantages and disadvantages that you can read about. So this is what I've just talked about. So proprietor, easy to start, least regulated, and they file in single tax on individual. They have unlimited liability, hard to raise funds. Transfer of ownership is difficult and is limited until the owner dies. The partnerships are formed in two ways: general and limited partners. General are all partners that are limited and liable for the obligations. And the document that is produced is called a partnership deed, maybe oral or written. So partnerships can also be limited in terms of their capital contribution, such that if there be any liability, only what they contributed. For professionals like law firms and accountants, they are limited to number of 20. Advantages are that it's simple to set up, low cost, relatively quick, and liability is limited to the partners. Unlimited liability for the general partner is a disadvantage and difficult to raise additional funds except to them that are within the partnership. And transfer of ownership is difficult, either at entry or death. Corporations, these are legal firms that have an artificial entity where the ownership is different from the company itself. It has a life. The advantages are there's limited liability and easy transfer of ownership by selling of a share, and has unlimited life and easy to raise large quantities of funds. Disadvantages is that you pay both corporate and personal tax, and it's difficult to establish and more expensive to set up. So this is how our unit one could be concluded. Any questions at this point?